Japan is holding a 1.2 trillion nuclear option over the US dollar, and with 20 million barrels of oil blocked daily, the Japanese yen is entering a death spiral that could wipe out your entire portfolio. So we need to talk about this. My name's Nick. I've been a professional investor and unprofessional trader for 24 years. Let's figure this out together. Look, the Japanese yen is approaching 160 yen versus the US dollar. This number is very important because this is where traditionally Japan steps in to protect its currency, to defend its currency. So if the yen weakens past this point, it raises the risk of government intervention, which can trigger sharp moves across currency markets and global markets worldwide, right? So inexperienced investors see this and assume American markets are insulated from all the chaos overseas. What's Japan got to do with America? But for those of you who don't know, Japan is the biggest holder of US debt. So the reality is that Japan's currency crisis is a direct threat to the underlying plumbing of the entire US financial system. And because Japan relies on oil from the Middle East for over 90% of its energy imports, with the Strait of Hormuz effectively closed and crude oil at like $100 a barrel, give or take, up or down, Japan is now paying record prices for fuel, forcing them to deploy $5 billion in emergency subsidies. So they are caught in this death spiral where rising oil prices destroy the yen, but then that makes buying oil even more expensive. And this also ties directly into a catastrophic debt trap that Wall Street is desperately trying to avoid. To defend their currency, Japan has to buy yen, and to buy yen, they have to sell the US dollar. Their 1.4 trillion war chest is mostly held in US Treasuries. So Japan is currently, like I said, the largest foreign holder of US debt, sitting around about 1.2 trillion as a pile of bonds. They have 1.2 trillion bonds. So I'm going to translate exactly what that means for you. If Japan crosses that 160 red line, they will dump tens of billions in US Treasuries. When the biggest buyer of your debt suddenly becomes an aggressive seller, borrowing costs in your country, in the US, explode. The US 10-year Treasury yield is already at an 8-month high of 4.38%. And analysts are warning that 4.5% is the ultimate tipping point for a stock market crash. The timing could not possibly be worse with all this, by the way. The US national debt just crossed that $39 trillion line, and the Treasury has to roll over a staggering $9 trillion in maturity this year, which is an obscene number. So they also have to fund, by the way, a $1.9 trillion fiscal deficit, so there is that to add on top of it. So if Japan starts dumping bonds, the US must refinance that massive mountain of debt at significantly higher rates. This guarantees a catastrophic explosion in interest costs that the American taxpayer will be forced to cover. So let's look at what happened during the flash crash of August 2024. Yeah, it was 2024. So the Bank of Japan surprised the market with a tiny little rate hike, and the yen rapidly strengthened from 160 down to 140. That single move triggered a violent unwind of the yen carry trade. Systematic trading algorithms panicked. The VIX spiked to 65-ish, and the Nikkei crashed like over 12% in a single day. So US equities were decimated, with the S&P plunging almost 8% in a matter of days, which is a lot for the S&P, by the way. So the underlying mechanism today is exactly the same as it was in 2024, but the powder keg is even larger. There's still roughly 500 billion outstanding in yen carry trades right now. If Japan intervenes to save the yen, those trades will violently unwind again. Traders will be forced to liquidate their US tech stocks just to cover their margin calls. This creates a crowded exit where everyone tries to sell at the exact same time. And here is the most twisted part of this entire situation. Between December and January, Japan actively added 39.8 billion in US Treasuries to their reserves. So they were loading the gun while telling everybody they wouldn't shoot. Now the Japanese Finance Ministry is holding unprecedented secret meetings with major banks in Tokyo. They are considering shorting crude oil futures directly to suppress global energy prices. They are perfectly happy to risk billions in derivatives in the derivatives market because the alternative is crashing the global financial system, right? Meanwhile, the US Treasury is explicitly refusing to help them. This is a very, very strange situation. In my like 24 years of trading, I haven't seen a setup quite like this. So Wall Street knows this standoff is happening, and they are using retail investors as exit liquidity while they quietly rotate out of overvalued paper assets, allegedly anyway. I mean, you know. So what does this mean for us? Well, When the largest foreign creditor of the United States is backed into a corner by a physical energy shortage, you do not want to hold highly leveraged paper assets. You do not want to be caught in the crossfire of a $500 billion algorithmic carry trade unwind. So I'm completely ignoring the short-term noise and that the equity markets are making right now. I'm out of a lot of US stocks, I'm out of tech stocks, and I'm focusing mostly on hard physical assets that cannot be printed or frozen. I mean, you guys know the deal. If you watch my videos, you know all of this by now. I'll see you in the next one.